Hello, fellow Robo Capitals. Hope you're well. So we got the new CPI report out. Let's go right over to CNBC and check out the details. And then we're going to go over to Zero Hedge. They've got some fantastic charts out there. Then we're going to see how bond yields, more specifically treasury yields, are responding. Because if you guys have been watching my videos, I think yesterday I was talking about it, how I thought there was probably a CPI to the downside priced in to treasury yields. So I don't want to give away too much here. Let's get right over to CNBC and check it out. The headline, we've got annual inflation rate slows to 2.9% in July, lowest since 2021, like we were saying in the title. But the month over month hit expectations. Month over month was 4.2% increase. And that's what brought, along with the base effects, the CPI overall year over year down to 2.9%. So again, to be clear, month over month, it was right in line with expectations. So I thought there was a downside or a downside surprise priced into the CPI yesterday when I was looking at treasury yields, because they went down for 2 or 3 days straight. So I'm like, they're probably pricing in a surprise, a softer than expected CPI report. And we're going to get into the price action with the treasuries, or the yields, I should say, in a moment here. And I think it's a tell for what we could see as far as the economy in the future. More on that in a moment. So excluding food and energy, volatile food and energy is what they always call it. Core CPI came in at 0.2 monthly and 3.2 annual, meeting expectations. 0.4 increase in shelter costs, responsible for 90% of all. Wow. I did not know that. Let's read this again. 0.4% increase in shelter costs was responsible for 90% of the all items inflation increase. Food prices climbed 0.2 while energy was flat. So if you strip out shelter, if I'm reading this correctly, they would have had a big miss. And the reason I focus on shelter so much is because if this is the metric I think they're referring to, the owner's equivalent rent, it's just completely bogus. It's just a concocted number that they say they derive from all these phone conversations that they have with people, and how much would you rent your place for? As if a homeowner is going to, like a normal homeowner, isn't going to have a very good idea. They're going to be ballpark, but they're not going to have a specific number. So yes, I could rent my apartment for $2,556.93. Like no homeowner is going to be, there's be like, yeah, I don't know, 2-3 grand, something like that. What they're hyper focused on is the actual price of the house. But it's a number that can easily be massaged when, if you actually look at the data from something like realtor.com, actual rents, you see that it could tell a much different story. Inflation rose as expected in July, driven by higher housing costs. Again, I think that's owner equivalent rent. We see everything kind of trending down, as you would expect, based on what's happening in the treasury market and the yield curve. So we had a negative print last month. Although that might, I'm going to have to dive into that a little deeper, because if my memory serves me well, I know we had a negative last month, but it wasn't negative 0.06. Interesting. All right. We're going to have to address that again in a separate video. Now let's get over to Zero Hedge, because they do a much better job than CNBC, or a much more thorough, complete analysis. So Zero Hedge, they point out, like we just said, down to 2.9, lowest level since 2021. Actually, lowest level since the beginning of 2021. And at the same level, I would point out as, 2018, 2017, which were definitely not considered inflationary years. So they say goods deflation continues to drag overall CPI lower. So they look at month over month, year over year. This more specifically, I believe, are the goods versus the services. So goods represented by this, see, consumer commodities less food and energy. So I think that's what they would consider goods. That's down negative 1.9%. That's year over year. And then we've got services less, and I don't know how energy would be a part of services, but that's 4.9. But as they state, the trend is obviously down. Man, the trend in goods. If you think that a good portion of the consumer price inflation that we did see was not a result of supply chains, just I present you this chart. I mean, you look at the money supply growth, and that's where everyone focuses. But I don't know that obviously both contributed to the consumer price inflation. But man, when you look at charts like this, it's hard not to lean over on the side of the majority of those price increases coming from the global governments just completely destroying supply chains. So that's those economic distortions that we talk about all the time on this channel. So then they get into the nitty gritty with the actual unadjusted 12 months. Okay, July 2024. So we're seeing energy so slightly down overall. We're looking at food slightly up, commodities slightly down. We've got new cars down, used cars way down, apparel down, and then shelter slightly up. Yeah, for the most part, it would have been a downside miss if not for the just completely and totally subjective owner's equivalent rent. And I would be curious to know what this number would actually be if you used data from Zillow or Realtor.com. My guess is it would not be a positive; it would be a negative, and that would bring the CPI print down even lower. And to be clear, I am not saying that prices aren't going up or we're getting deflation. And most of you guys know this. I'm just specifically talking about the trend. That's it. You know, when we hit 9.1% inflation in the summer of 2022, were we really at 9.1? No. It was probably closer to 15. But and now are we right at 2.9? No. Not for most people. And the stuff that you buy daily, it's still going up at a higher clip. It's just the trend is really what we're focused on, because that tells us about what's happening on the supply side, but it also tells us what could be happening with aggregate demand, which is giving us insight as to the health of the overall economy. Now let's go over to Market Watch, and this is where it gets really interesting. So 2-year Treasury, which you would assume would have, it's at the shorter end of the curve relative to the 10, 30-year. So it would be more impacted on expectations for Fed cuts, Fed increases, et cetera. And we see right when this number was released. Actually, let's go back. This is why I thought the market could be pricing in a soft CPI print. That's what I was referring to earlier. And then when the report came out, you see this. Let's go back to the 1 day. You see this big spike. And that kind of confirms my suspicion that when we had the number hit expectations, it's like, oh, we got to raise rates. But then look at what happens next. Then the market wakes up and is like, well, wait a minute here. It hit expectations, but the economy still sucks. So, right back down to where it was before the CPI print came out to begin with. And look at the 10-year. The 10-year did the exact same little spike, but it's gone negative. I mean, not by much, a couple basis points, but it's still negative on the day. And the 30-year, I'm guessing, let's actually pull that up, guys. Let's see what the long end did. Oh, wow. Okay. That's really, check this out. So the 30-year was way, way down, then it spikes up, but it only spiked up to the level pretty much where it started this early morning. And then boom, drops all the way down. Now we're down almost 4 basis points since the report came out. So this is basically the treasury market. Some speculators, let's say, were betting on a soft print, got caught off sides, sell everything, and then the bond market sits back and says, yeah, this is a nothing burger. We're still headed in the exact same direction that we've been telling you guys. And that's for growth and inflation to go down, or likely, no certainties, but likely headed toward a recession, or for this cycle to play out the exact same way that it's played out almost every single time going back to the 1950s. And that's when you get an inversion, you get the bull steepener from the front end going down faster than the long end, you get unemployment spiking up, you get the data softening, you get the narrative change. We go from bad news being good news to bad news being bad news. Then the Fed, in response, drops rates. Once they drop rates, the curve really steepens out, and then you get the stuff hitting the fan. This time may be different, but from what I see, it's playing out the exact same way. One other story I wanted to bring up, and let's check this out, because you guys know from watching my videos and just using common sense that nowadays the global economies are very interconnected. It's difficult to have just massive consumer price inflation in the United States, the UK, Australia, Canada, like we did in 2021, and not see consumer price inflation pretty much in every other major economy around the world. Same thing for disinflation. And if we had a hard landing, let's say, it would be very surprising to see the UK, the Eurozone, China, Japan, Australia, Canada going straight into a recession or experiencing an actual recession, while the United States, well, their economy is growing at 3% in real terms for as long as the eye can see, or in other words, a no landing. That would be possible, but is it probable? I don't think so. So what I want to show you is what's happening in China right now. I just saw this as I was at the gym this morning. So China, we're going to do steel. We're going to do crisis, their words, not mine, and Bloomberg. So world's top steel producer warns of severe industry crisis. Iron ore collapses to lowest since last year on demand outlook. Cash now more important than profit. China Baowu boss says. Now, this, I'm just trying to read. I don't subscribe to Bloomberg, obviously. The world's biggest steel producer sounded the alarm about the industry crisis in China that carries the potential to ripple around the globe. It's according to Bloomberg, not George here. It's not George, the economic guy with a tinfoil hat that's out there fear mongering. I'm just telling you what they're just taking all the data and presenting it to you and saying, well, the data would suggest that these outcomes are becoming more and more probable when you look at the data in aggregate. If you sit there and cherry pick here and there, you can tell whatever story you want. They say this crisis in China that carries the potential to ripple around the globe and plunge the sector into a deeper downturn. You say, well, George, this is just because of the real estate market in China. Okay, fine. But that was the engine of economic growth for the global economy for quite some time. So let's say that's coming to an end, if not going the opposite direction. Well, where's your growth engine now? Is that somehow going to be the United States? That's somehow going to be the EU? Again, possible, but not probable. But let's go down. I want to point out their specific terms they used in Bloomberg, because I think that's important. I think I tweeted about this earlier this morning. Here we go. No, that's India. China's steel industry is facing crisis more severe than the downturns of 2008. China's steel industry is facing a crisis more severe than the downturns of 2008. It said, highlighting a need to preserve cash and liking conditions to a severe economic winter. But look, why are they preserving cash? Ask yourself that question. What is cash? Well, it's safe and it's liquid. What else is safe and liquid? Ah, that's right. That would be treasuries. So if you continue to see the treasury yields go down, if you continue to see a bull steepener, what is that telling you about the action? Forget the words. The actions of these global multinational corporations. It tells you, and then the financial institutions, it tells you that they are seeking out safety and liquidity. Why? Why would they do that? If the economy was booming, if we're going to have a no landing, if the economy was on fire, why would they be seeking out safety and liquidity in the U.S. Treasury market? It's a rhetorical question. What these Treasury yields tell you is that the health of the global economy is very weak right now. The health is very poor. It's structurally unsound because of these economic distortions that were created by the central planners going decades back, but what was really emphasized during 2020 and 2021. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. See you in the next video.